In 2006, officials in Beijing introduced a new stance for the property market, that housing is for living, not for speculation. Today, we want to ask what happens if they do a U-turn and announce that property is actually for speculation after all. Before 2016, property in China was almost always primarily seen as an engine of growth, to be turned on when it was needed. Sure, there were costs to doing this, in the form of asset price inflation and excessive credit growth. But for previous administrations, these were costs that were worth paying. By saying that property is actually for living, Xi Jinping signalled that this was no longer the case, and that for him and his administration, the costs of property reflation outweigh the benefits. Now, it did take time for this message to get through, with property prices actually steadily rising from when that policy was announced in 2016 all the way through to 2021. However, coming into 2020, and the government upped the ante, announcing the so-called 3 red lines to control developer borrowing. Since then, the change in real estate activity is quite remarkable. This week's data for June show that sales are just 50% of the peak of a couple of years ago. Starts have receded even more quickly, falling to just a third of where they once were. That Xi Jinping's government feels differently on property is therefore undeniable. But we doubt that this outcome was what was wanted, in the sense of a resizing of the sector in one fell swoop. That property nonetheless did collapse was probably because of the interaction of the 3 red lines with the COVID lockdowns. In a sign that there is now some regret, ever since the third quarter of 2021, officials have been trying to stabilise things, with help for developers and inducements for buyers. Now, these efforts are clearly understandable. Real estate accounts for around 20% or maybe more of Chinese GDP, so its collapse has caused nominal GDP growth to slow to just 4.8% year on year in Q2, and importantly pushed the deflator below zero. That's only happened twice before in the last 20 years. On each of these previous episodes, that fall in the deflator triggered major policy intervention. The huge stimulus policies of 2008 and the combined property reflation and supply-side reform of 2015. So history suggests that the economy is now weak enough to warrant a big shift in policy. Hence our opening question. Does the government now U-turn, announce that property is for speculation after all? Now, of course, this is unimaginable. The government has simply invested too much political capital in its property crackdown. And frankly, even if this did happen and Xi Jinping or other officials appear on TV saying go speculate, we doubt that many people actually would. The cat seems to be out of the bag. The last 3 years has broken the long-established assumption that property prices in China can only ever rise. Now, this doesn't mean sales will fall forever, but if the best that can be hoped is for property activity to stabilise at 50% of pre-COVID levels, then the current huge hole in aggregate demand will persist. Without then an alternative engine of growth, this implies continued deflation at a macro level and slumping nominal GDP growth, which in turn will exacerbate the difficulties caused by China's existing high debt levels. This doesn't really feel like a stable equilibrium. There is an argument that the government is fine with all of this, because it's hoping that this isn't 2008 or 2015, but rather 1997. The deflator then also turned negative, but the policy response is now remembered as being structural. SOE closures, bank recapitalizations, WTO entry. On this reading, property today is the state sector of the 1990s, where rationalisation has long been overdue. At the same time, new industries are now clearly emerging, with the China's statisticians these days always eager to highlight rapid growth in EV and solar cell production. Now, there is something to this argument, but we also think that it will be made irrelevant if the short-term cycle remains so poor. This, I think, was recognised 25 years ago, when structural reforms happened with significant cyclical easing. As an example, from peak to trough, the official policy rate back then was halved, falling from 12% in the late 1990s to just 5.3% by 2002. With policy unchanged, The best short-term case for China, it seems, is a weaker US dollar provides some reprieve from deflation. But in such circumstances, China macro probably can only go sideways. And even that might not be enough to preserve China's domestic financial stability. After a reprieve earlier in the year, real estate equity and debt is already trading back near the lows. All of this context, I think, makes it very easy to think that there's still another leg down for markets to come, and in particular in terms of what's happening with yields in China. As a concluding thought though, let's assume that this actually is 1997 and there's a brighter future ahead. We still think it has to involve more policy stimulus, including lower rates. It's also worth remembering that the clear recovery in China's cycle when Zhu Rongji was in charge back in the 1990s didn't materialise until 2002-2003. So if the 1990s are any guide, there's going to be no improvement in risk sentiment in China anytime soon. For more analysis on the economies of China, Japan, Korea and Taiwan, including regular notes, curated charts and data, please sign up to our website at eastasiaecon.com. Thank you.